So, what I'm about to explain to you is over a decade in the making of the exact strategy that scaled me to millions and millions of dollars with stocks and options. I'm going to try to be as clear and concise about everything here just to get to the point and then move on to the next thing because it is really, really hard to cram all this information into one presentation just like this. So, if you're serious about scaling your portfolio, let's dive in. So really quick, like why to listen to me, you could see I started out in 2018 with nothing, now scaled to roughly 1.2 million bucks just in this trading account. I have a few other accounts by the way, but I'm just showing you like, why listen to me, why give me your time and invest in this presentation. Like I get it, your time is valuable. I'm walking to walk in, I'm talking to talk to. I have my SIE exam, I have my insurance exam, I did my Series 7, former stockbroker, over a decade of experience, scaled to millions without luck, which that's a really big thing to just do this the right way and not get lucky and get rich. Multiple rental properties, featured in Bloomberg a few times, many businesses that I've owned and sold. I understand the art of simplicity, and I'm always going to be a student of the craft. That's critical in the investing world because, nobody knows everything. You always have to try to be learning, refining your skills, refining your strategy, and just always trying to be a better investor. That's kind of what it's all about here. So this whole presentation is going to revolve around the 6 needle movers to win. The first one's going to be investing in theory versus in practice, the emotional aspect, luck versus skill, building your portfolio, options, and how to start right now. So the first 3 parts that we're going to go through, maybe you're going to be like, I don't care about that, Brandon, just show me how to build my portfolio and do stock options. I get it, and we're going to get there, but I really just want to bang through 1, 2, and 3 really quick here, because if we skip to number 4, you're going to get smoked. You're not going to make money in the long run doing this. You have to understand these aspects just so you have it in the back of your head to understand it. So investing in theory versus in practice. Like in theory, it's easy, but in practice, it's hard. And as Mike Tyson says, everybody has a plan until they get punched in the face. Like what happens when your stocks go up? What happens when your stocks go down? Like what if you win? What if you lose? Most people are just making blind trades and they just simply don't know what to do. They don't know, when do I sell for a loss? When do I double down? Or when do I take profits? Like think about it. Like a lot of people have been having the problem right now because the market's just been going up like crazy at the time of recording this. They're like, when do I take profits? I don't know when to sell. And what if I sell the stock doubles from here? Like, what do I do with that? And then what if you buy a stock that you love a lot and then it goes down in price? Do I sell for a loss or do I double down and lower my cost basis a little bit lower? We're going to cover that stuff here. And just the reality of this is that people just don't have any clue how to manage this. And it's, a really big problem. Now, the emotional aspect of investing is literally the number one reason why most people lose money in the stock market, simply because humans are emotional creatures. You've probably found yourself buying when things are going up and selling when things are going down, and you realize after the fact that doing the opposite is probably a lot better than just, doing what the herd is doing. And of course, you probably over allocate on low conviction plays. Maybe a stock is going up, you hear it from someone at work saying, oh my God, I'm making so much money, and you're just simply buying because they're buying, but you don't really know why you're buying. So, the main reason why you just end up losing money is because you just have no system. You don't know really what you're doing. You're kind of just making blind trades and guessing. Now, we do have to bang through this chart right here because trust me, like, I know it's unsexy to talk about the emotional aspect of investing right now and you want to go into options and how to build your portfolio. We're almost there. I just want to get through this chart really quick. So, typically when most people buy stock, the stock goes up a little bit and they're like, oh my God, this rally is real. I'm optimistic right now. So they buy some shares, they make a little bit of money. As the share price is going up, they're like, oh my God, I was right. I believe in this rally. This is time to get fully invested, take my capital off the sidelines, and now bring it in. Then it goes up even more, and they're like, oh my God, this is thrilling. I'm going to buy more on margin, and I'm going to tell everybody to buy. And why am I going to do margin? Because I heard you can make more money doing this on margin, because now I'm an expert. I should be doing this in a leveraged way. And then the market goes up even more, and you're like, I'm a genius. I'm euphoric. We are all literally going to be rich. Like, what color Lamborghini am I going to get? And you're just sitting on your account, and you're seeing all your paper gains of you're up 500% or whatever you're up, and you're like, I'm looking good right now. But then the stock market blows off a little bit. Takes, some sort of retracement lower, and then it starts to grind a little bit higher. Then you start to get a little bit complacent. You're like, well, maybe this rally just needs to cool off a little bit before the next leg higher. A little dip, and then it's going to go up like that and just pump out of the moon. But then what happens is crash, 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 anxiety, denial, panic, and disbelief. This cycle right here happens time and time again with stocks. Remember what I said earlier. Most people buy up here, and most people sell down here. You kind of want to just do the opposite of what the herd does. And in this presentation, in just a second, we're going to go through it, the mechanics of how to do this. But I just want to show you that the peak up here when it's euphoric, That is the point of maximum financial risk. And then on the dip, when everybody is panicking and they're depressed and they're disbelieved, like that is the point of maximum financial opportunity. You want to buy when people are fearful and you want to sell when people are greedy. Warren Buffett said that, and it's obviously true. So when you understand that stuff, you could capitalize from that, and we could also use stock options to magnify our expected returns at the point of maximum human emotion. So if I just go back to this, people are euphoric, they are buying call options, they are buying shares. Maybe we could use that to our advantage. Down here, people are scared, they're buying put options, they're selling their shares. Maybe we could use that to our advantage with stocks and options, and we are. I'm going to show you how to do that. So what's the solution? Something that works in all markets, takes out the guesswork, removes the emotional factor, and only takes like an hour a week, and you could do this like anywhere in the world. Low risk, and it's not overly complicated. You know, we talked earlier how I want things to be simple. This is simple. I could explain it to a 12-year-old. It's what I've been doing for years. Okay. So the first part of what we're going to do here is we're going to take your day job money, whether you have a day job, a business, however you make money. We're going to funnel that to your broker. The second thing we're going to do is build a strong base portfolio. The third thing is going to be to buy options. Fourth thing is going to be to sell options. And then the fifth thing is going to be reinvesting your profits in a base portfolio. So this is what the rest of the presentation is going to cover. This is getting into the bones of the stuff right here. But before we get into building your account, let's talk about the day job stuff, or whatever you have, a day job, a business you own, however you make money. You want to increase your value in some way, shape, or form. Like, talk to your boss. Try to find a higher paying skill. What can I do to take on more responsibility? Pick up overtime. Simply work harder. Like when I was getting started out there, I was working 50, 60, 70-hour weeks, working multiple shifts all week long, 7 days a week, because I wanted to get the money in my brokerage account, get it compounding, and do options when it makes sense to generate that cash flow. Because you only have to get rich one time. And once you get rich, it's just kind of smooth sailing from there. So this presentation is honestly going to help you out a lot. So remember, I was trading a lot of time for money starting out, but right now I do not trade time for money anymore. I make my money work for me so that I could save time with other things. So trading time for money is going to be temporary. But once you have extra money, do not increase your standard of living. I see a lot of people say, well, Brandon, I make more money now. I want to go and get a better car, go get a bigger house because I'm getting a deal or whatever. Don't raise your standard of living just yet. You could do that down the road, but right now give your portfolio a raise instead. All right, so building a base portfolio, this is very, very critical because it's going to act as the foundation, the stability. It's where you're going to compound, you're going to have collateral, and you're going to be able to do leverage from this in order to do options in the right way. Most people do options the way that, you see online. It's a popular way to do cash secured puts, cover calls, whatever it may be. I'm going to explain to you in the rest of this presentation as to why I think that's the wrong way. I'm going to prove to you why that's the wrong way. And by the end of this, I think all of your questions and concerns are going to be shut down about why the herd doesn't make money and why Brandon makes money and why people that do this system make money too. They don't want you to make money out there in the real world. They don't want you to make money in Robinhood or Schwab or E-Trade or whatever broker you use. They want you to just sit there and transact and make a bazillion trades, generate fees, get your things to operate on the wrong side of the bid-ask spread, and just lose money. We're going to cover all this stuff right here. So for the base portfolio, funnel all of your money here, whether it's W-2 wages, trading profits, option profits, business profits, you sell your car, you sell your house, whatever. This acts as the foundation and the starting point for everything else that happens in your portfolio. All extra money is going to go here. And like I said, many people do options completely wrong and they skip the base portfolio part, but that is a major, major critical mistake. Don't do that. Why is that a big mistake? Because you're not going to be able to compound your money in the base portfolio. You're probably not going to have your ratios in check. You're going to have no self-control when you go do options because let's say you have a $20,000 account, you send $20K to it, but it's like, how much money do I spend on these call options that I'm going to buy? How much do I spend on whatever? You're not going to have your trade ratios in check and your self-control is just, you're not going to have self-control. You're going to have no foundation. You have no starting point. You have no system. You need that critical foundation. It's like the foundation of your home. If you don't have the foundation, everything comes crashing down. And one of the biggest things that not many people know about is the base portfolio is going to be used for selling put options, which we'll get to in just a minute. But we're probably not going to do that as cash secured. There is a better way. Maybe you know, maybe you don't. Maybe you think, hey, Brandon, that way sucks. Give me a little bit of time in this presentation to explain that to you because you're probably going to think a little bit different about that towards the end. And of course, you have no tax advantages if you don't build the base portfolio. If you have all this stuff in your base portfolio, you're not paying taxes until you sell or until you realize these gains. So maybe there's a way that we could use the base portfolio as a way to do stock options in a better way to generate more profits and generate more cash flow and have your taxes way, way lower than the other way around. So the typical retail trader, again, they're going to over leverage, they're going to rage trade, they're going to want to just get even on that one trade that they are down on. You're going to want to get lucky like most people. You probably have hope as your primary strategy. And to be honest with you, you're probably just going to try to control the uncontrollable. Sorry, I'm in the way a little bit here, but you could understand what the rest of the words are there. So most people that don't have the base portfolio, they have all this money in stock options trying to 10x their account overnight, and they end up having a bad beat and never end up scaling to the next level. I have seen this with hundreds and hundreds of people that 1 out of 100 get lucky. 1 out of 100 day traders make it, but 99 out of 100, they don't make it. The screenshots that you see online, those are the winners. They don't show you the losers. Like, that is why the base portfolio is the starting point, and we use options to magnify high confidence plays. And again, free shares. When we do options, I'm going to show you how to get free shares in your base portfolio. Because think about it. Options have an expiration date. They don't last forever, but shares, you could hold shares forever. So what if we trade these option profits for shares that are probably going to appreciate in price? This is how you get that exponential growth and compound better than what the market does year after year after year. Okay, so what do we put the base portfolio in? Some of it's going to be in the S&P 500, some will be in the NASDAQ, and some will be in individual companies. Regardless of where we put it, and this is more geared towards individual companies, but of course we could value the indices and see if they're overvalued or undervalued. But whatever you buy, it just has to be trading near or below intrinsic value, which that is just, kind of like the true value of the company, which I'll show you how to do that in just a second. So intrinsic value, they have to have a moat, they have to have pricing power, they have to have a durable competitive advantage, and you have to be okay to hold this stuff for the long term. If you do that, your base portfolio is going to do just fine. Now, how we organize that, it's going to be allocated to the best future expected returns based on earnings per share growth, revenue growth, valuation levels, interest rates. All of this stuff is going to come into play because we're going to know, look, this is where we're going to get the best risk-adjusted return based on interest rates, market valuations, revenue growth, blah, 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 all this stuff. We will allocate to the best risk-adjusted way. Now, maybe you're going to be like, well, Brandon, the S&P 500 sucks. It's boring. Again, it's only part of the base portfolio. But I just want to show you this chart right here just to show you where probably you're going to end up falling in the, compound annual growth rate bucket. So this goes from 2002 all the way to 2021, 20 years of returns right here, annualized. So there's the average annualized return for the average investor, 3.6%. That's not really that good when inflation is 2.2%. So your true return is really only 1.4%. And on top of that, you're probably going to be paying taxes on this. So you're probably just on par with inflation. Now, if we look at the S&P, 9.5%, and that's 9.5% for doing nothing. You could sleep. You could have went into a coma for 20 years. You could have bought it 20 years ago and did nothing, and you would have done much better than the average Joe investor. So maybe you're going to be like, all right, well, maybe I'm not the average Joe investor. Maybe I'm better than the average Joe investor. Well, I'm going to show you this chart right here. This is the Robinhood Investor Index. So this basically takes a collection of all the accounts on Robinhood, and it figures out how much money they actually made. And I don't just want to show you this chart to say, okay, the NASDAQ did better than what Robinhooders did. There's a lot of psychology that plays into this. So going back to 2020, you could see that the Robinhood Index, they were doing better. Why? Because the market was absolutely ripping. As the market starts to rip higher, the Robinhooders typically have no clue what they're doing, and this applies to many brokerage accounts, to be honest with you. But Robinhooders are where the newbies are. Most of the newbies are, at least. And there's some good people. I'm just, picking on them right here for this example. But they made more money when the market was going up. But look at from peak to trough right here. They went up more, but they went down way more than what the actual NASDAQ did because they're euphoric and they're making a lot of money. They're buying calls, they're doing leverage, they're doing whatever they want to do to get a higher return. They're doing leverage ETFs. They did good. But then as the market starts to fall, they capture that leverage return on the downside too. So then you're going to be like, well, Brandon, why didn't they get a better return off of this base rate here? And it's simply because the average Joe is like, I just lost all this money. Screw the stock market. I'm never doing it again. Okay, now it's starting to go up. Maybe I should buy back in. Oh no, it dipped right here for Liberation Day tariffs. Oh no, now it's really ripping higher. The tariffs are off. And now they're leveraging into the market at the time of recording this video, roughly October of 2025. But at the end of the day, from start to finish, who did better? This is a NASDAQ and this is a 5-year chart. As time goes on, it's going to be more clear that the typical average Joe investor simply is probably going to underperform the index. And this chart right here, it's going to pan out to be accurate. And honestly, if most people would just spend a little bit of time in their day listening to this presentation, they are going to completely change how they look at stocks and options forever, because we have a lot of critical things to get into. I'm going to show you screenshots of my portfolio at the time of recording this. There's a lot of good stuff that we're going to go through here, so make sure you stick around until the end. But maybe you're like, okay, look, Brandon, like I'm better than the average investor. I'm not a Robin Hooder. I'm going to be fine. Are you better than a hedge fund guy? So if you invested $100,000 at the beginning of 2010 in the average hedge fund, it would have been worth $214,000. But in the S&P, it would be $538,000. So again, maybe you're not a Robin Hooder, maybe you're not a hedge funder, maybe you're better than all them, but you're probably not, to be honest with you. So when people DM me or message me on X or comment on something, they're like, hey, Brandon, do you really think you're better than the hedge fund guys? And I'm like, yes, I do, because my compound annual growth rate that I show everywhere smokes what these people do. Like at the time of recording this video, it's almost double what the indexes are. And this is not in a 2-year time frame. This is 5-year time frames and even longer than that I've been through bull markets and bear markets. And this system has worked through the ups and the downs. We kind of got the base portfolio figured out. And I know you want to get into stock options. So let's do it right now, because this is honestly where the magic is. This is where the money is made. This is my favorite part to present right here. So options are leverage. That's what they are. It's simple. They're a way to magnify your returns. But the obvious thing right here that many people don't really understand is, if you don't know with a high degree of confidence what direction the stock is going to move, why would you want to make a leverage bet on that? Just like think about that in your head. If you're buying a call option, you are buying the right to buy shares at a certain price in a certain time frame. Number one, you have to get the timing right. Number two, you have to get the direction right. So it's like, if you don't know the timing or the direction, why are you making a leverage bet on that? Like, dude, you're just gambling your money. Like, stop doing that stuff. So most people are doing options blind and they just don't have a clue what they're even trying to accomplish with them. But also most people are broke. So when you understand that, most people do it wrong. Most people are broke. Oh, coincidence. That's probably why. So don't forget that aspect here. So the way that I look at options are this. Buying options are for the home runs and selling options are for the base hits. And most people end up striking out every single time they're trying to do a play in the stock market, whether they buy calls, buy puts, whatever they're doing. They want to 10x, they want to 100x, they want to get rich overnight. And when they do that, instead of getting consistent wins month after month after month, year after year after year, they are trying to go straight up, get to $1 million and sell and just say, I'm done. But in reality, that doesn't work, and most people just end up striking out. So for options, and this is very, very, very critical to understand, what do all the CEOs of the companies want? They want more earnings per share, more revenue, a stronger moat. They want to dominate their field, and they want to be more efficient. That is what the CEO's job is. That is what the CFO's job is. That is what the board wants to do. That is what the employees want to do, at least most of them. And when you do all this stuff, the share price is probably going to go up, because as earnings per share goes up, which are profits, the share price is going to follow that in the long term. So the number one thing that moves the price of stocks in the longer run is what? What do you think that is? It's earnings per share, baby. That is the profits. If you buy a company, any company out there in your neighborhood or your town, whatever, you want to know how much you're paying for it. The second thing you want to know is how much money do you make? That's what it all comes down to. All the other stuff is important, but at the top of the list, what are the freaking profits? Are they expected to grow? Is it durable? Is it going to be consistent? Is there domination? Do they have pricing power? Like, all this stuff matters for earnings per share, but earnings per share at the end of the day, that is what moves the stock in the long term. In the short term, like, we don't know, it's all bouncing around, it's like vibrating out there, so it's very hard to know where the stock's going to go in a couple week period. But as time goes on, it becomes very obvious where stocks are going and why, based on everything I'm going to present to you in this presentation here. So again, you have to stick around. We didn't even get into the things that, like, I would have paid like $100,000 for this presentation when I got started, because the things we're going to get to in the end, it's like totally would have changed my life if I learned that faster. But this took me 10 years to figure all this stuff out. And this is just the key things that matter right now. And yes, I'm just a guy on YouTube, but you have to trust me that if you get to the end and we stick through this, it's going to click for you. So how long until they can move the needle for growing earnings per share? How long does it take for a CEO to grow their earnings per share? Typically about a year, okay? So remember that, because we're going to come back to contract durations in a second, And you're going to be like, oh, now it makes sense because I understand how long it takes them to raise earnings per share. So when we're buying options, this is like swinging for the home run. It's harder than a base hit, obviously, because just look at baseball. Is it more home runs or more first base hits? Obviously, first base hits. So when you try to swing for that home run every single time, it's much harder. There's a higher chance of loss, and you're going to be a lot less consistent because, again, you're trying to crush it out of the park every single time. And you have to be much more precise with your timing and your directionality. There's not much room for margin of error in this because you just have to be very, very accurate when you buy options. I'm going to show you how to buy options, buying puts and buying calls in a second, but you have to be very, very precise. So when you're buying puts, a lot of people love to buy puts on companies they feel like are bubbles or going to crash or whatever. But understand that you're betting against the company. You're betting against the CEO and the board and the employees and what everybody wants to do. Like, all the executives of these companies, they're all compensated with stock options. So they're incentivized to get the stock price to go up. But when you're buying puts, you are betting against them and wanting the stock price to go down. Yes, sometimes this makes sense, but this is a very, very hard way to sustainably make money in the stock market. Now, buying calls, though, you're betting with the company. They want earnings per share to go up, profits to go up, revenue to go up. If you give them time and you buy calls at the right time, you will make a crap ton of money doing that. And I'm going to show you exact examples of screenshots in my portfolio of why I do this, how I do this, and just the whole logic behind it in just a second. So now you're going to be like, okay, buying options is hard. Buying calls is a little bit easier than buying puts because I'm betting with the company. So what duration should we typically do when we buy calls? I like to say a minimum of 6 months, but usually a leap, which is a call option over 1 year in duration. And side note about a leap, it's the only option strategy where if you do it and you hold it for more than a year, you will get treated as long-term capital gains, which could save you a lot of money if you make a lot of money. And then the max duration for buying puts, that's going to be a maximum of 6 months. Because think about this, the longer duration that you bet against a company for, the more likely they're going to be to increase their revenue and increase their earnings per share. And in the long term, the stock price is probably going to follow that growth. So again, you don't want to bet against that for too long because you have this tailwind of growth coming and you're kind of betting against that. But when you're buying call options, where I said a minimum of 6 months, you have the tailwind going for you. And when you let that build into it, you let a couple earnings reports come through, they're guiding better, earnings going up, revenue's going up a little bit. That is a tailwind for the stock to go up, and you're much more likely to make money doing that. All right, so now we're going to get into some of the bones with buying options right here. And if you're listening to this in the background, I think now is a good time to look at your screen and really understand what I'm talking about here because I'm going to point out a couple things. But let's just talk about buying call options really quick here. Remember, we're still in the buying options section. We're not selling options just yet. We're going to get to that in a second because selling options and buying options in the right combination way, it is so powerful to make a lot of money. And I'm going to show you that screenshot into my account of how I was bullish on a company. I sold some options, I bought some options, maybe I bought some shares, and how I just blew it out of the park and made a crap ton of money doing this. It honestly feels like cheating how good this strategy actually works. But now you're going to have a couple light bulb moments here. Okay, let's say that we're going to buy a call option because, this is a NASDAQ 5-year chart, by the way. And let's just say that you're going to buy a call option right here, okay? Call option here versus call option here. What is the sentiment of the market? Number one, what is the sentiment of the market here versus right here? The sentiment's pretty good right here because the market's going up. The herd is like, yeah, I'm making money, a little volatility, dippy-do, die-day, but I'm doing okay. So the sentiment's good. But what is the sentiment right here? This was Liberation Day when the tariffs came and the market fell roughly 22%. The sentiment's not good right here, right? The market's scared. So just even right here, are you going to pay more for a call option here or more for a call option right here? If you do the same call option, you're going to pay way more for it here because sentiment is high and there's going to be a lot more demand for it. So there's going to be more premium for that because the herd is saying the market's going up. It's going to keep going up. I'm buying call options right here. Maybe you just pay arbitrary numbers, $1,000 for a call option right here. But if you were to buy the exact same contract here with, say, a 6-month expiration date from there and 6 months expiration date from here, maybe when you buy on the bottom of Liberation Day, instead of paying $1,000, you might pay like $600 because the sentiment is low. Now, let's understand the timing of this a little bit. Is the market more on sale right here or more on sale right here? You're going to say, well, Brandon, the market's at the same price for the most part. Like Triple Q is at roughly $440 per share. If it's at the same share price, you're going to be like, Brandon, it's not any cheaper. It's the same thing. But remember what happened here. 1 year went by of earnings per share going up, revenue going up. These companies are now more valuable with any index. So not only is it cheaper here fundamentally, even though it's the same share price, sentiment's bad, demand is down, and the premiums are going to be lower. So this is when I like to buy call options down here. So like I was saying earlier, we're going to use this stuff to our advantage and capitalize at the point of maximum human emotion. So buying a call here versus here is great. So let's build on this a little bit more, and I want to go to the duration of the call option. So let's say that you buy a 2-year call option as a leap, 2-year option leap, and maybe you buy the call option right here. We'll just say that Triple Q is at roughly $400 a share. This was at the top of 2022. Let's go 2 years out. We're now at the top of 2024. Overall, the market, it's $400 a share to $400 a share. You did not make any money with that call option simply because the market didn't go anywhere. So maybe you spent $10K for it up here. It's going to expire worthless for the most part because the stock just didn't go up. So your timing was not right. You're going to say, well, why did the contract go down to a value of 0? Because it's out of the money, and every day that goes by, the contract's going to be worth less because there's theta. Theta is the time decay. Just think about it. Like if you call up your auto insurance company and say, hey, I want to buy auto insurance and I either want to pay for 1 month or I want to pay for 1 year. Which one's going to be more expensive? The annual policy or the monthly policy? You're going to pay way more for a year than a month because you're way more likely to get in a car crash in a year than a month. So you paid all this premium up here at the top of the market and you just lost it all. That's what a lot of people do. So that's why your timing has to be right. And we're going to build on this for actually selling options and using that to our advantage because maybe when the market's up, the sentiment's up. Like here and here, the sentiment is good. The demand is going to be good. The premiums are going to be good. So when people are paying top dollar for call options right here, that's going to be a time to sell call options. That's where we're going to be able to sell them for more premium. We're going to go to that in just a second in the next section when we're selling options. But let's just say, okay, the market fell 36% right here. What is the herd thinking? They're thinking like, oh my God, the market fell, the market crashed. I need to buy put options because that is a downside protection on my portfolio. So sentiment is bad. When sentiment's bad, they want to buy a put option. The implied volatility is going to be pretty darn high right here because the market's bouncing around like crazy. The sentiment's bad. People are just scared out there. They're willing to pay more for a put option. So demand's going to be higher. People want downside protection. Everybody wants that insurance. The demand's going to be higher. So the premiums are going to be higher. So think about this. When all of that is pointing to more expensive put options, is that a time to buy a put option or a time to sell a put option? You're going to want to sell a put option, not buy a put option. But the typical ding dong is going to buy the put option here and they're going to buy the call option here. But again, they're doing this at the complete opposite time. They should not be doing that stuff. And the strategy that we're going to build into here that I didn't even talk about yet is how we could maybe buy call options and sell puts and buy shares at the same time without having cash in your portfolio and without sitting on margin in order to capitalize on the sentiment, the implied volatility, the demand, the premiums, and the timing and theta to our advantage to make big banger plays and capitalize humongously. So we're going to come back to this in just a second. All right, so now we're going to sell options. We're not buying options anymore. We're going to sell options. And I know I kind of just went all over just piecemealing things in there, but it's going to all come full circle here in just a second, and it's all just going to click and make sense. So selling options, specifically selling call options right now, max duration of 6 months. Why? Because you're betting against the company and the CEOs. The goal of selling a call option is like in a perfect world, you would sell a call option right here, the contract would go down in value, and you just collect that premium and you move on with your life. So you don't want to bet against a company for a long duration of time. Same as buying a put option. You don't want to bet against them for a long period of time. So this again is 6 months. Now, selling put options, this is where you're going to get paid to buy someone else's shares cheaper in the future. Just say that out loud. Buying someone else's shares 6 months from right now, you're getting paid to do that for a cheaper price. You could really make a lot of money doing this stuff, and you could do this in combination with other option strategies to really hit it home and make a lot of money. We're going to get into that in just a second now. But 6 month duration minimum, because we need time for the companies to grow their earnings per share, grow their profits. You get it. All right, so let's bring this together here. Let's talk about what was happening down here in 2023, and we could even do the Liberation Day tariff dip too. Actually, let's do the Liberation Day tariff because I think it's going to make more sense right now because it's more recent. So market fell a lot. Market got a little bit cheap down here. Companies like AMD, NVIDIA, TSM, Meta, Google, whatever, companies like that, they fell quite a bit below intrinsic value. So they're cheap. I want to hold them for the long term. They have a moat. They have a durable competitive advantage. They're solid companies that I want to hold. So what was the sentiment down here? Let's just take AMD, for example. What was the sentiment down here when AMD fell? Again, I know this is a NASDAQ, but the chart looks very similar, to be honest with you. AMD fell a lot. The sentiment was bad. Oh, they're not going to compete with NVIDIA. The chip sector's done. Everything's overvalued, blah, blah, blah. Sentiment was bad. And then number two, what was the implied volatility down here? It was pretty high. It's like, oh my God, the market's going up and down like crazy. Trump's doing all this crazy stuff. He's very unpredictable. We just don't know. Implied volatility was very, very high. Now, what is the demand for stuff down here? There's not a lot of demand to buy calls down here because the market's falling and the herd likes to go in a direction of what the market's doing. So there's no demand to buy call options down here. All the demand is to buy put options down here. So think about that. Where the demand is how we want to capitalize on human emotion. So when everybody wants to buy a put option down here, demand is going to be high and premiums are going to be high. So we are going to sell a put option down here because that's a bullish play. You want the stock to go up, stay flat, or not go down to the strike price. So as the market's falling and it's getting cheaper, that's a good time to sell puts for top dollar because the herd is buying put options for top dollar. So maybe we sold some AMD puts, and I think I sold like $40,000 worth of AMD puts down here. Okay, so now I have $40,000 of cash sitting in my account. Well, what do I do with that cash? Well, if I think AMD is cheap, I don't want to have cash sitting in my account because most people will do cash secured puts, but in my opinion, that is ridiculous and that is dumb, and we'll cover this more in just a second, but I want to invest that cash maybe back in AMD because I'm bullish. So I just want to make sure that that really clicks for you here because you're selling a put option for top dollar. You take the premium, you buy calls, and you buy shares. The market runs up a lot. You're going to do very, very well on those options right there. Now for timing and theta. So here's the thing that is controversial, and most people are going to try to fight me on this. Go in the comments and talk about it, but let me explain to you before you go type out your comment because I'm probably going to answer your question right here. My duration for sold puts when I did AMD right here was 2 years. I sold 2-year put contracts on AMD. You're going to be like, oh my God, Brandon, that is insane. Why do you want to tie up this contract for 2 years? Why do you want to tie up that buying power for 2 years? Listen for a second. Let's say that you would say, Brandon, why don't you just do a 1-month contract? Okay, let's run through it together. If you would sell a 1-month put on AMD right here, maybe you collect $1,000 in premium. Are you going to do okay with that? Sure, you're going to do just fine. You're going to make a lot of money because the market's going straight up. You made $1,000. But if we just multiply that times 24, I know it's not always perfect science like this, but you do it for a month, I do it for 24 months. That's 2 years. I'm going to collect $24,000. But think about this. I'm collecting $24,000 right here when AMD is cheap, when it's sharply down, when it's very undervalued. I'm going to collect $24,000 at that time and then immediately redeploy that capital in shares and call options. So I have more money generated at the bottom of the market when the market is cheap. But you, on the other hand, you're going to sell a put, make $1,000, sell a put, make $1,000, sell a put, make $1,000. So yes, you made a lot of money as the market's going up, but now that it's a little bit more expensive, you're not going to make anywhere near as me because now you're kind of like, well, I only want to sell put options when the stock is cheap. I don't really think it's cheap right now, so what do I do? You made maybe 5K right here, but look at what I would have done. I would have sold the puts right here, made like 25K. Take that money and buy call options. The call options roughly doubled in price. I sold the call options. But on top of that, I had shares left over. So I let the shares run up in price, and the put contracts that you're saying, well, Brandon, you bought 2-year contracts, those aren't going to expire out of the money for a long time. You're right. But I sold them here when the sentiment was bad. So people were paying top dollar for the put. So once the market rebounded very, very quickly, I was then able to get rid of those puts and sell them because the sentiment flipped and nobody wanted to buy puts anymore, so the value of the put contract went down. And again, when you sell puts, you want to sell it for a lot and buy it back for a little bit. So I think I held those put contracts for like 2 to 3 months. I think I realized a 75% ROI on them. You can only get a max of 100% ROI on sold puts. So I captured 75% of the profit on the sold put for only holding it for 3 months. So yes, it was a long contract, but I got the bulk of the money in 3 months and I didn't have to hold it for the remaining 21 months in that. That is why longer duration is better because I'm generating the cash flow on the bottom of the market when the market is cheap. But if you do monthlies, you're going to do good here, but you're not going to be able to make as much because you're doing it 1 month at a time. Do it all in a bulk when it makes sense. Don't try to do monthly option contracts. You're not going to make a lot of money doing that. And to build on this a little bit, like here's an example of what I did on United Health. You could see that I sold 10 put contracts, collected $42,000 in premium, Took that money, I bought some shares right here, I bought some calls right here, and I bought some calls right here too. 3 call contracts here, 1 call contract right here. So the total trade right here, like if we just say 25K, 50K, 60K, 70K, I made $70,000 on this trade. I've only held this trade for like 2-ish months right now. And by the way, these calls are closed out. I only held this trade for like 2 months. But look at my ROI. Like think about if you would have just sold a 1-month put contract, you would have made like $5,000 or $10,000 probably. I made $70,000. I made like 7 times what you made. I'm going to get in when it's cheap and I'm going to get out when it runs up a little bit in price. You know, that is the name of the game, and that's why this is so powerful. Now, this screenshot right here is going to silence you. If you're going to say, Brandon, this is risky. You're doing these put contracts, like these put contracts right here that I'm selling. You're going to be like, that is risky. You're going to get margin called. When the market crashes 40%, you're going to get wiped out. Let me explain right here how this works. So currently right now, I have $1.8 million that I could generate within 7 days. I call that 7-day liquidity. My current assignment value is roughly $516,000. And I just want to point this out because some people might notice this. This screenshot right here is from 10/31 of 2025. That's when I'm recording this video right here. This screenshot's from a few days before that. So that's why if you add up my assignment value, it's not going to equal this number exactly, but it's very, very similar overall. So let me just make this click in your head. And I want you to understand that this is why this strategy is so, so powerful. I could generate $1.8 million in 7 days. We get it. $1.8 million divided by my sold put assignment value. So let me explain to you what that means. So what that means is, let's just take United Health here for an example. I have 10 contracts, and 10 contracts times 100 shares, because every contract is 100 shares. That means I'm on the hook to buy 1,000 shares of United Health at $230 per share. So you multiply that together, my assignment value, meaning I have to come up with $230,000 of capital. That's what I got to come up with to buy these shares. And most people think like, oh my God, that's risky. But if you really use your head and understand this, it's like, dude, who would not want to buy United Health shares for $230 per share on 12/17 in 2027? And I got paid $42,000 to do that. Like I literally got paid $42K to sell this put option. So that's what assignment value means. So when we add up my current portfolio at the time of recording this video, my assignment value is roughly 29%. $516,000 is my total assignment value. And when you divide that together with my 7-day liquidity, I have a 29% assignment value. So in English, what this means with a 29% value is this. If the market falls 70%, a 70% stock market crash, I will still have capital to take assignment of everything. I won't have to take assignment on margin. I could if I want to, and honestly, I probably would if the market fell that much, because it's probably going to rebound very sharply out of that dip. But this shows you that if the market falls 40, 50, 60%, which 60 would be crazy, I'm going to be just fine. My ratios are in check. This is why the base portfolio is so powerful, because you could do this stuff. I could generate extra premium, buy extra calls, buy extra shares when the market is cheap and when all of that makes sense. Most people will say, I have cash sitting on the sidelines, and I'm like, that's just dumb. Because if you think United Health is cheap, put your money where your mouth is and stand behind your research that you did. I researched the crap out of these companies, and I understood that it was cheap. I sold puts, I bought calls, and I bought shares. You don't see Warren Buffett going and, buying shares of Apple and then buying put options right after that and hedging himself on the downside. You got to know how to understand this stuff, how to value companies, and how to have a good margin of safety, and you will print money in the long term doing this stuff. So max acceptable assignment value right now at the time of recording this video is 35%. Why? Because max assignment value in a cheap market is 75%, but max assignment value in a lofty market, which right now we're a little bit expensive in my opinion, 0 to 50%. So as the market's more expensive, I want to have less leverage. And as the market's more cheap, I want to have more leverage. That's just how the market works. Usually when it's cheap, future expected returns will be good. And usually when it's expensive, future expected returns will not be as good. So right now, I'm pretty cautious in my opinion. So we covered a good chunk of information here, but honestly, there's still a lot that you're missing, such as when to buy, when to sell, like exactly how to value companies, exactly what companies and ETFs I do this on, how to spot the deals, how to build conviction, how to cut through the emotions. I have calculators to use, how to reduce taxes, how to put this on autopilot, market mechanics, more of how to use this to your advantage, and how to do short duration plays. So again, this was just a 1-hour class, and I just simply could not fit everything into it. So if you want to finish the training, go much deeper, and get access to my mastermind Discord community for free, 100% for free, there's no strings attached. It is legitimately free. This will be the perfect system to do my long duration plays, do my short duration plays, and get access to the rest of the course, the rest of the system to really understand, hey, what are we doing right here? So the course is step by step, everything that matters. You're going to learn my exact plan step by step, no wasted time. It's about 8 hours, decade in the making, and over 1,000 people already went through it. And Discord is what is going to completely change your life. You're going to get my main trades and the risky trades because we have this AI bot that sends out a bunch of trades every day. We take the ones that are 80% chance of profit or higher, and they honestly bang like it's been really good. I don't want to say it bangs every single time, but it's very, very consistently good on the ones that are like 75, 80% or higher. So that alone is worth everything right there. But again, the main trades, that's the big stuff that I do. You're going to get a lot of value from that. Audio updates every day after the market closes. I talk about what's going on, cut through the noise. This will save you a lot of time in your day-to-day life. Breakdowns, all the big companies that report that are on the stock sheet, which this is just an organization of market valuation, scorecards, and what companies are good and what companies are bad, and which ones we potentially make some plays on pretty soon. And then every Wednesday at 5 p.m. Pacific time, we do a Zoom call. Those are recorded. So if you want to come into that, it's definitely going to change your life. For the next few days, we do have a free trial. You're going to want to check that out. Scan the QR code on the screen right now, or in the video description, I'm going to put a link to join for free. You get a free day trial. Check it out. You could cancel whenever you want. Trust me, this is going to change your life. Drop a comment if you made it all the way to the end. I want to know who are the people in here that really care about this stuff and who really wants to scale to true financial freedom. If you made it, drop a comment and say, I made it. See you guys in the next one.